Well, good morning all. Welcome to our latest webinar, which we've called Trusts Explained. My name is Patrick King. I'm a tax partner at MHA, and I'm joined as usual by James Kipping, another tax partner at MHA. Now, those of you that have been listening to our series of webinars will have heard us mention trusts a number of times, usually in the context of tax planning and the like. But we've had a lot of questions as we've been going through about what a trust is, how it works, how you form one, that sort of thing. So what we thought we'd try and do today is address those issues. I would just warn you that normally when we do a trust course or introduction to trust course, it's half a day to a day in length, and we're trying to do it in 45 minutes today. So this is exactly the sort of challenge I like, but we are going to have to hurry through reasonably quickly and hopefully have some time for questions at the end. I will be looking at what a trust is and how they work, and then some different types of trusts and their uses. Then James will take over to look at the tax treatment exemptions and reliefs that relate to trusts, and then we'll be doing a few examples, the sort of things that a trust might be used for, before hopefully we have time for a few Q&As at the end. So, what is a trust? Well, a trust basically, it's a quirk of English law. It's almost, I wouldn't say it is unique, and almost unique I know is not a true statement, but you don't find trusts generally outside of countries or states that operate a legal system, and usually based on English law. Now, as we know, English law is prevalent in quite a large area of the world because we used to own a great chunk of it. So you will find trust law in America, in Canada, Australia, New Zealand, all sorts of islands that we used to own all over the place. So it's not just the UK, but it's largely not recognised across the continent in civil law jurisdictions, although they have their own funny things called usufructs and the like, and foundations, which we don't really recognise. So there is something a bit like trust law, but trusts are usually English. They date back a long way. If you go back as far as the Crusades, knights in shining armour and lords would go off to fight in the Holy Land. They knew full well that they were going to be gone for years at best, and there was a good chance of not coming back. They wanted to look after their family, and so they would find a friend or a trusted relative to transfer their assets and their estates to look after for the benefit of their families in the future. And out of that, the concept of trust law was born. And what it is, in essence, is that within English law, it's possible to split the ownership of an asset between its legal title and its beneficial title. So you can have a legal owner who actually owns the property under law, and the person who's entitled to the benefit of that asset, and they can be separate people. And where you have that split, effectively you have a trust. It's very difficult to give an exhaustive definition of the ranges, but I will have a try on a slide a bit later on to give you an idea of the types of trust there can be, although most of them are pretty irrelevant for what we're talking about. So the main element is that a trust is created by the relationship when a settlor, so the person giving something away, transfers property to trustees, who are the legal owners, for them to hold for the benefit of certain designated people who are the beneficiaries. So you have a settlor, who's a person giving stuff, you have trustees who hold it only legally, you have beneficiaries who are the people who are going to benefit from it going forward. How do you create a trust? Well, there's broadly four ways, and the way we invariably use is the first one there. A trust deed or instrument is drawn up. So we go to a lawyer to get a trust deed drawn up to achieve what we wanted to achieve. And that can be a whole range of things, but that would set out how the trust operates. Trusts can also be formed, though, by implication. So if people act in certain ways, potentially a trust can be formed. They're notoriously difficult to prove, so it's not something we go into deliberately, but they do happen. You can have constructive trusts where law imposes a trust. And there can be trusts created when someone dies, for instance, without a will. Under intestacy law, there are trusts created. Trusts are ruled by the law of particular states, and normally when you set a trust up, you will decide what it is. And invariably, in our case, it's going to be England and Wales. but it could also be Northern Ireland or Scotland, where the rules are slightly different. And of course, the US, Canada, Australia have their own trust law, although it is very similar to ours. It's based originally on English law. When you set up a trust, it's basically irrevocable. Once you've given something to trustees, you can't get it back. That's the starting point. However, before it becomes definite and irrevocable, you have to meet 3 certainties. And they are that it has to be absolutely clear what the intention is. So what you intend, the trustee needs to be clear on what the plan is. There needs to be certainty over what you've put into the trust, so the subject matter, what is there. And there needs to be certainty as to the objects of the trust, i.e. the beneficiaries. Who are they, or who are they going to be? That needs to be clear. If any of those are not entirely clear, then it's possible the trust becomes void. And if a trust becomes void, what happens is the assets that you've tried to put in the trust will usually just bounce straight back to the settlor. So if the plan is to get assets out of your estate for inheritance tax purposes, for instance, which it often is, you failed because it's come back to you. So you obviously need to make sure we've got those 3 things sorted out. It also needs to be properly constituted. And by that, I mean, when you set up a trust, you transfer maybe a property or shares or cash to trustees. You have to do that formally and properly. So if it's land, for instance, it needs to be done by deed. If it's chattels, it's going to be by delivery. If it's shares, you need a stock transfer form. Whatever the asset is, you need to transfer it properly and legally to the trustees. They will become the new legal owners. Quite early on in the creation of trusts, it was worked out that it wouldn't be a good idea if trusts could last forever, because you'd end up with potentially huge swathes of the country tied up in trusts forever and a day. And so the law of perpetuities was introduced, and currently, since 2010, that is 125 years. So all normal trusts will have to come to an end within 125 years. There's a different rule for charities. They, in theory, can go on forever. But broadly, 125 years is the period. Prior to 2010, and so there are still a lot of these trusts around, the perpetuity period was 80 years, or a life in being plus 21 years. So what does that mean? Well, normally settlors would decide upon something like the youngest child of the reigning monarch as being the life in being. So when that youngest child died, the trust would then have a further 21 years to run. It could be a very long time, but equally people die young. So it could be, you have uncertainty over what the length of your trust is going to be. So often it was 80 years. There's also a question of how long income can be accumulated within a trust. Trusts don't have to hand out income or assets to beneficiaries at any particular time, unless the rules say they do in the trust deed. But there are limits to how long you can accumulate income. That always used to be broadly 21 years from the death of the settlor. You can see on the slide there are a few other options, but broadly that was how long you could accumulate income. And the reason that's important is that often there are differences between beneficiaries entitled to income and the beneficiaries entitled to capital. So obviously if you could accumulate income forever and add it to capital, then the income beneficiary could get nothing. But if you have a law against a law against continued accumulation, you can't do that forever, and eventually you have to hand it over, or you then have to distribute it to the income beneficiaries. The new rules since 2010 are a little bit different. Now it's just 125 years and you can do what you like. So in theory, you can accumulate for the whole of that period if you wish. Trustees have, as you might expect, quite a wide range of responsibilities and powers. These will normally be set out in the trust deed. That'll say what they can and can't do, what they need to think about, etc., what they can invest in. But to the extent it isn't, and behind whatever's in the trust deed, we do have rules or duties of care set out in the Trustee Act 2000. Broadly, they have to have understood and know the trust deed, so they know what the trustee says they can do, and they need to operate with such care and skill as is reasonable in the circumstances, as it says on the slide there. If the person who is a trustee is a professional, they will be expected to operate at a higher standard because they are supposed to know more broadly. But basically, you do have to operate with care, with the beneficiary's interest always in your mind. If we look at investment powers, for instance, The trustee will normally set out what powers of investment the trustees have, what they can invest in, that sort of thing, who they can pay for advice. But if it doesn't, they do have powers to invest anyway. They're treated effectively as if they own the assets absolutely. Now, they do own the assets legally, but they don't own them beneficially. So that is important to know. They do have the right to invest those assets as if they owned them completely. But they could, for instance, just go ahead and decide they want to invest in Bitcoin because it seems like a good idea. They wouldn't do it with their own money, but the trust money, why not? Or they couldn't just chuck it all in rare Ferraris, thinking that's a dead cert increase in investment. They have to take account of standard investment criteria, so they have to review the circumstances, they have to assess suitability of the investments, they have to think about diversification, and they need to take professional advice. It's very important for trustees' own position that they take proper investment advice if they are making investment decisions for a trust. For instance, investing in the family company may not be reasonable on a standard investment basis unless it's expressly provided for in the trust deed, which often it will be. But that just shows the need to think about things carefully and consider the benefit of the beneficiaries. There are also a number of powers as to how trustees can act if the deed is silent on certain matters, and these are the most important of those shown on the slide there, section 31, 32 and 33 of the Trustee Act 1925. They provide the power for trustees to do certain things, to dish out income, to potentially advance capital, but they are quite restrictive by modern standards. So most modern trusts will have extensive powers covering all these areas set out in the trust deed. And to the extent they refer to these sections, they will often be saying that these sections are misapplied in whole or in part because the trust deed gives them wider powers or better powers than those particular sections do. The reason they're mentioned there is that if you don't mention them, they are applicable, and they can be both good and bad because they are relatively restrictive compared to the powers you can get yourself by setting up a trust correctly. Trustees have powers to nominate or delegate power or authority to experts, specialists to do certain things. They can't do everything. For instance, they can't give away the power to decide when to make distributions, etc., or appoint trustees. And the thing to remember is that if you are a trustee, you retain a duty of care at all times. So the fact you've delegated a power to someone to look after for you doesn't mean you're not still responsible. You have to continue to review the position. Appointment of trustees. Now, there's no set number of trustees. You can have one, you could have 10. One is generally not a good idea because obviously a trustee is a person and a person can die, or an individual can die. If you have no trustees, you then got a potential problem. You might need to go to the court to get new trustees appointed. I tend to normally suggest 3 as a good number, or 4. Being, or in often cases, it's a husband and wife setting up a trust for children or other family members. Usually I'd suggest the husband and wife are trustees plus one other, which could be a professional or it could be a family friend. They're the sort of things I normally say, but it's not a bad idea to have a professional as a trustee to make sure you meet all the rules, but you don't have to. I would generally suggest you have someone outside the immediate family, but again, you don't have to. If you have someone you trust that much, you bring in, then that's a good idea. There are various rules set out in the Trustee Act if the trust deed itself does not set out how you appoint trustees. But generally, as I say, with modern trust deeds, you would set out how you can appoint trustees. The settlor would appoint them to start off with, and then the trust deed would set out how new ones are appointed, usually by the trustees in the future if you need to, for whatever reason. Variation of trusts. Well, I mentioned early on that trusts once made are irrevocable, and that is generally the case. You can't, having settled assets into a trust, just take them back again because you changed your mind. It's quite difficult. But as we also mentioned, there are some cases where things can potentially be changed. The first one I mentioned earlier on, certainty. If you don't tick those certainty boxes, then the trust could fail and become void. You have to make sure you transfer the assets in correctly. So if gifts in are incomplete or illegal, potentially the trust can fail. And I've had a case years ago where previous advisors had got something wrong. There was potentially a huge tax bill as a result of setting up a trust. But when I looked at it closely, I saw that in that case, the shares in the company concerned had not been transferred correctly. So I was able to undo the whole thing and save the day, or at least semi-save the day, which was fortunate. But equally, it can be bad if it goes the wrong way. If a settlor is insolvent at the time, or reasonably close to the time they settle assets, then trustees in insolvency can potentially undo a trust as being a means to escape their creditors. Divorce courts also have quite wide powers to set aside trust arrangements where they're seen to be avoiding responsibilities, and equally inheritance tax, inheritance provision for Family and Dependents Act sets out certain requirements for dependents to be cared for. So if a person's tried to put all their assets into trusts to escape doing that, again, potentially that can be set aside. Lastly, on this slide, we have the rule in Saunders and Vautier, whereby if beneficiaries all come together and they're all of sound mind and legal age, and they decide between themselves they want to do certain things not provided by the trust, then they can. They can bring it to an end, they can dish out assets and so on. But it does take all of them to be involved. If they're not all of sound mind or of full age, then it may be possible you need the court to do it. So broadly, once a trust is set up, that's it, it's there for good. So just very quickly, types of trusts. I said at the start I would have a stab at showing a range. Now, don't try and read all that. That just shows that potentially there's a huge number of slight variations in types of trust. But in reality, there are probably three or four that we generally look at. They are bare trusts, interest in possession trusts, discretionary trusts, and less now than it used to be, accumulation and maintenance trusts. Now, all the trusts on the previous page fall more or less into one of those categories, in whole or part, which is why these are the main categories. And the ones we tend to deal with the most are the two in the middle, interest in possession and discretionary trusts. What is a bare trust? A bare trust is a situation where the legal ownership is different to the beneficial owner, but the beneficial owner is actually entitled to everything. It's just owned by someone else on their behalf. So you might use these, for instance, when the beneficiary is not willing or particularly able, or is not yet of full age to deal with the assets. So the legal owner will look after it for them until they reach full age or full capacity, or they decide, having reached those milestones, to say, hand over the assets now, please. So the trustee has to do what told by the beneficiary once the beneficiary is of full age or of sound mind, if they've lost their sound mind for some reason, due to illness or whatever, and they're recovered. If we move on to interest in possession trusts, this is where the beneficiary does not have an entitlement to the assets underneath. The trustees own it, but the beneficiary does have an entitlement to either the use of the asset or to enjoy income from the asset during their life or the term of the interest in possession. Usually, well, always, there will be a person after the life tenant, the person with the interest in possession, who will be entitled to the assets at the end, and that person is usually called the remainder man. So you can see where we would commonly use these. They would often be used in a situation where spouse number one dies, leaves assets on trust for his wife or her husband for life. So they have use of it or income from it during their lifetime. And when they die, the trustees pass the assets on to the children. And that might be used commonly where it's a second marriage and there are two lots of children from different partners, for instance. In practice, interest in possession trusts can be set up in such a way that the trustees have a lot of discretion over how long that interest in possession may last and where the assets underlying it may go to. So interest in possession can be set up for certain purposes and then removed quite quickly thereafter. And James will probably say more about that later. Move on to discretionary trusts. So discretionary trusts, as the name perhaps suggests, is where no beneficiaries have the right to anything here. The trustees have complete discretion to decide who gets what and when. Now, normally they will have been given some guidance by the settlor in an expression of wishes as to what they would like, but the trustees do not have to follow that. they should take account of it. But basically, they have to assess the situation and then deal with distributions of income and or capital to the beneficiaries as seems appropriate to them based on the facts in front of them at the time. But normally they will follow the expression of wishes as closely as is sensible to do so. So these are often used where you have younger children, young family members who don't want to hand over control of large amounts of money or assets as yet, but you might do at some point in the future. And so you give them to trustees in the meantime to look after until that point. And at that point, I shall hand over to James for him to talk about taxation of trusts, where it gets interesting.
Thank you, Patrick. Right, yes, as Patrick said, I'm going to talk about trusts and specifically taxation. I'll run through the tax treatment of discretionary and interest in possession trusts in the main, but before I do so, I think it's important to understand a couple of general and overriding principles. So, first one being, if the settlor and their spouse are not excluded from benefiting from a trust, then it's what we call settlor interested, and therefore income arising to the trust is taxed upon the settlors. Otherwise, income arising to the trust is taxed in the trust itself. There's a similar rule for inheritance tax, whereby if a settlor can benefit, then the transfer is ineffective for inheritance tax. That is, that the value of the trust remains part of the settlor's estate. For income tax, we must also be aware of what we call the parental settlement rules. So that's where income arises for the benefit of minor children as a result of a settlement. In that case, it remains taxable on the parents, if it's the parents that have made the settlement in the first place. This covers a wide range of situations, including where assets are settled onto express trusts, but also where money or assets are simply gifted to children. General settlement rules have wider application. And where there's a settlement of a gift and the transferor retains a benefit, but I won't go into detail on that particular aspect. As I will explain, the tax rules that apply to different types of trusts generally follow a logical path, following the scale of benefit for the particular beneficiaries. Patrick has already mentioned bare trusts and what they are, and the fact that they are generally a legal ownership point, and therefore, for tax purposes, the income and gains of the trust are taxed in the hands of the beneficial owner. That's because the bare trustees are simply nominees in this instance. The value of the assets held on a bare trust are also included in the beneficiary's estate for inheritance tax purposes. Focusing on income tax, and firstly in regard to interest in possession trusts and looking at the trustee's position, an income in possession life tenant, so someone with an interest in possession is known as a life tenant or a life tenant beneficiary, and they have entitlement to income but not capital. So subject to administrative collection rules, the beneficiary is taxed on the income. So where the trustees collect and manage income, they account for basic rate tax on that income. So the trustees pay 7.5% tax on dividend income and 20% tax on savings and non-savings income. The trustees aren't given a personal allowance or a dividend allowance or a personal savings allowance. So in that regard, it's straightforward. If, on the other hand, the income is mandated to the beneficiary, so is received directly by the beneficiary and not paid to them via the trustees, then the trustees can avoid the need to report the income at all, and they won't pay tax on it, and it will be reported directly and taxable directly on the beneficiary. If we look at the beneficiary's position, where the trustees receive income and pay tax on it at the basic rate as I've just explained, the trustees will usually complete an R185 trust income form and provide that to the beneficiary, showing their income entitlement from the trust and the basic rate tax credit attached to this. That's the tax paid by the trustees. Now, the beneficiary is taxed on the income as if they received it directly. So they will be able to apply their personal allowances, dividend allowances, and other allowances accordingly. It's important to recognise that income retains its character. So it is taxed as dividend income. It is taxed as non-savings income, depending on what the nature of the income is that arises to the trustees. A non-taxpayer, or a basic rate taxpayer with allowances available, will be entitled to a refund of the tax paid, or some of the tax paid at least, by the trustees. A higher rate or additional rate taxpayer beneficiary will have further tax to pay on the trust income via their own self-assessment return. Looking at discretionary trusts, these are taxed differently, certainly for income tax purposes, on the basis that in a discretionary trust, the beneficiary is entitled only to what they are distributed. So that means the beneficiaries aren't entitled to anything by right, and therefore the trustees must report all income and pay income tax on this at what we call the rate applicable to trusts. Now, the trustees will have a standard rate band of £1,000 within which income will be taxed at the basic rates, similar to those for interest in possession trusts. That basic rate or standard rate band is divided by the number of trusts that the set law has created, but doesn't go lower than £200. All income above this standard rate limit is taxed at the additional rate of 38.1% for dividends and 45% for savings and non-savings income. So the rate applicable to trusts is essentially the highest rate of income tax. But that tax paid by the trustees forms part of what we call a tax pool, and this is then used to frank income distributions that are made to beneficiaries. So if we look at the beneficiary's position, when a distribution is made, or rather when a discretionary income distribution is made, this will be issued with a 45% tax credit. Now, that means that a net distribution of £55 will equate to a gross distribution of £100 with a £45 tax credit. Now, the tax credit reduces the balance in the tax pool, so the trustees need to have paid sufficient tax to cover the tax credit on the distributions, or what we call a tax pool charge will arise. And this creates complications where the primary income of a discretionary trust is dividend income, because dividend income is taxed at 38.1%, but when the income is, or when the net income is distributed, it must be franked with a 45% tax credit. The beneficiary is taxed as receiving non-savings income. In other words, their discretionary income distribution doesn't retain its character as the underlying income of the trust. It's just discretionary trust income subject to tax as non-savings income, no matter what the original source. But as the income is paid with a 45% tax credit, there will not normally be further tax payable by the beneficiary. It's possible in rare situations for further tax to be payable, but that's certainly not normal. Usually, a refund will be claimable for the excess tax paid by the trustees if the beneficiaries are only, say, 20% or 40% taxpayers, or if they don't pay tax at all. So you can see that the headline rate or headline income tax rate applicable to discretionary trust is the highest rate of income tax. But if all the income is distributed through the trust, although there's a fair bit of administration involved, the income should only ever be taxed effectively at the marginal rate of the beneficiaries, save for in those situations where there's complications caused by the primary source of income of the trust being dividend income. Another administrative point, really, that certain expenses incurred by trustees can be relieved for tax purposes. And these are called qualifying trust management expenses. Now, they can affect the tax due on the trust income. To be qualifying, they must be properly chargeable to income, not capital. So actually it's quite restrictive as to what fees or costs are claimable. So fees for preparing an income tax return and R185 forms, for example, typically our fees and our compliance fees for trustees would be trust management expenses. But expenses relating to capital gains tax, inheritance tax, managing the capital assets, and typically this might be investment management charges, are not trust management expenses. Now, where trust management expenses are claimed, no higher or additional rate tax will be due on income used to pay trust management expenses. As I say on the slide there, the method of how this is achieved differs depending on the type of trust, and I won't go into that in any more detail. Just another point to note that bare trusts cannot claim trust management expenses. In a discretionary trust, the trust management expenses extend the basic rate band, so the standard rate band, so that they pay tax at lower rates on the income used to pay the trust management expenses. The tax paid on trust management expenses doesn't form part of the tax pool, so that adds another layer of complication where care must be taken when making an income distribution to ensure there's sufficient tax in the tax pool to frank the distribution. Trust management expenses payable or paid by interest in possession trustees don't change the tax payable by the trustees, but they do reduce the income attributable to the beneficiaries and therefore subject to tax on the beneficiaries directly. Capital gains tax, again, is slightly different because in both an interest in possession trust and a discretionary trust, the beneficiaries are not entitled to the capital of the trusts. So the trustees are liable to pay tax on the capital gains arising. Trustees of both types of trust are entitled to an annual exemption equal to half that of an individual. So the individual's annual exemption currently is £12,300 per annum. That reduces to £6,150 for trustees. If a set law has created more than one trust, the annual exemption is split between them up to a maximum of 5 trusts. So you never divide the annual exemption by more than 5. Trustees are liable to pay capital gains tax at the higher rates. So currently we have a higher rate of 28% for residential property and 20% on other gains. The basic rate that can apply to individuals of 18 and 10% don't apply to trustees. And just a point to note that trustees are liable to report and pay capital gains tax on the disposal of residential property within 30 days. That's 30 days of completion, just as an individual is now required to do from April 2020, I think that was. Most reliefs and exemptions that apply to individuals can also be claimed by trustees, provided, of course, that relevant conditions are met. And I just want to raise a couple of these. Holdover relief. Now that's holdover relief for capital gains tax purposes. May be available when assets are transferred into or out of a relevant property trust, and I'll come on to what a relevant property trust is in the next section. But that allows essentially assets to be transferred onto a trust and out of a trust without capital gains tax being applied. And this is commonly used, or commonly the availability of holdover relief in this situation rather is one reason sometimes why a trust is used to pass assets down a generation in the first place, on the basis that, let's say we have a property. If parents or grandparents, for example, want to transfer a property to children or grandchildren, then an outright gift could incur capital gains tax liability. Whereas if it's possible to make that gift via a trust, so perhaps transfer the property onto a trust for those beneficiaries, then holdover relief can be claimed such that capital gains tax is not payable. It doesn't mean the capital gain goes away. It's simply deferred until such time as either the trustees or the beneficiaries in due course sell the property. Business asset disposal relief, or formerly entrepreneurs relief, can be claimed in certain situations. And I'll raise this, I don't want to go into any particular detail, but other than to say that where trusts hold, for example, shares in a family company or an interest in a business, where if those assets were held directly by a beneficiary, they might qualify for entrepreneurs relief. We might be able to do some planning at least 2 years in advance of a sale to secure relief for the trustees. It used to be possible or at least it was thought it was possible, to do planning rather closer to a sale, but a recent case has found against that belief, if you like. Inheritance tax. This is where trusts can sometimes get quite complex. Now, the inheritance tax treatment is not as simply split between discretionary trusts and interest in possession trusts. Instead, we need to determine whether a trust is what we call a relevant property trust. And if it is subject to the relevant property inheritance tax charges, or the relevant property regime, as I might refer to it as. Since the changes introduced by Finance Act 2006, most trusts, and certainly most trusts created during lifetime, are relevant property trusts. Now, the main exceptions are bare trusts, because this is mainly an ownership point, as we've discussed. Qualifying interest in possession trusts, that is, interest in possession trusts created prior to 2006, or certain interest in possession trusts created under a will. So those trusts that we refer to as IPDs, or immediate post-death interests. Less common, disabled persons trusts, trusts for bereaved minors, qualifying accumulation and maintenance trusts, and 18 to 25 trusts are also not relevant property trusts, but they're much rarer. I think it's sufficient here to say that, you know, we have relevant property trusts in the main, and certain qualifying IIP, interest in possession trusts generally, are not relevant property trusts. So when does IHT apply to a relevant property trust? So when assets are settled onto the trust in the first place, the value in excess of the nil rate band available to the settlors will be liable to inheritance tax at 20%. So if the settlor has a nil rate band available to them of 325,000, then they can settle up to £325,000 onto a relevant property trust without any inheritance tax implication. They then lose their nil rate band, if you like, for the next 7 years, and they can do the same thing again in 7 years' time if they wish. Further tax can become payable if the settlor dies within 7 years of creating the trust. Once the assets are held on a relevant property trust, on each 10-year anniversary of its creation, the trustees will be liable to inheritance tax of up to 6% of the value of the assets in the trust. That's 6% of the value in excess of the available nil rate band. When assets are transferred out of the trust to beneficiaries, the value of the assets appointed out will be taxed again at up to 6%, depending on when in the sort of 10-year cycle that appointment is made. So if we make an appointment after 5 years, then the maximum charge loosely that can apply is 3%. It's important to recognise here that these charges can all be reduced or eliminated by the application of reliefs such as business property relief or agricultural property relief. For non-relevant property trusts, and mainly, as I said, qualifying interest in possession trusts, that is, interest in possession trusts created before March 2006, or certain interest in possession trusts created under a will, the assets of the trust are treated as belonging to the life tenant for inheritance tax purposes. So they're outside of the relevant property regime that I mentioned previously. There's no 10-year anniversary charges, there's no exit charges, there's no entry charges, but the assets are treated as belonging to the life tenant, even though they're held on trust. And therefore the value of the trust assets will be included in the estate of the life tenant on their death. Now, in that situation, the trustees are then liable to pay the inheritance tax attributable to the value of the trust assets on the death of the life tenant. If the life interest ends during the life tenant's lifetime, perhaps because the trust provides for that to happen, or because the life tenant revokes their life interest, the inheritance tax position on that scenario depends upon the particular situation. So where assets pass to an individual, absolutely, this becomes a potentially exempt transfer. So there's no inheritance tax on the occasion of that life interest being withdrawn, but the value remains in the estate of the life tenant for the next 7 years. Where the asset remains in trust, this revocation or ending of life interest becomes a chargeable transfer, immediately liable to inheritance tax at 20% to the extent that the value exceeds the available nil rate band. Sorry for the typo in the last line there. Reliefs and exemptions. Look, Each trust has its own nil rate band, reduced by chargeable gifts, that's broadly gifts onto trust made by the settlor in the 7 years prior to the creation of the trust. If the trust was created on the same day as another trust, or the settlor added property to more than one trust on the same day, the nil rate band is shared between them proportionally. And as I mentioned in an earlier slide, agricultural property relief and business property relief can be claimed by the trustees once they meet the relevant conditions. So this can reduce or eliminate the relevant property charges that I ran through a moment ago. I'm conscious of time, so I might skip through some of these, but just a couple of final points on trusts. And I will skip over the first bit because I know that one of the examples that Patrick's going to give is in connection with the use of life interest trusts. So I'll skip over that. But the second, or the two final bullet points on this slide, just make reference to the fact really that we've not discussed here non-UK trusts. We've focused on UK resident settlements or trusts. However, where there's a non-UK domiciled settlor, if the assets are held on, or rather if the assets held are non-UK assets, then these can obtain beneficial tax treatment as excluded property trusts. So sorry, that's a pretty convoluted way of saying, if I have a non-UK domiciled client with non-UK assets, I might advise them, rather than create a UK settlement, I might advise them to create a non-UK settlement and hold those assets on trust offshore, and that will, provided certain conditions are satisfied, keep the value of those assets outside of their UK inheritance tax estate, even when they become potentially UK domiciled or deemed domiciled by virtue of their presence in the UK. As I say, in the final point, these are complex and have further restrictions, so I think it's probably necessary for a further discussion on that. Quick point on the trust registration service, and this is administrative but nevertheless important. Since March 2018, trustees with a UK tax obligation, so that's an income tax, capital gains tax, inheritance tax, or stamp duty, have needed to register online with HM Revenue and Customs. Now, the trust register keeps details of trustees, beneficiaries, settlors, and other individuals associated with the trust for the UK's international reporting obligations. Now, there can be penalties for not complying, which is the reason I raise it. It's just to make sure that those of you with trusts or trust clients are on top of this. From the 2019-20 tax year, registered trusts have needed to complete an annual declaration to update any changes to the trust, or indeed to confirm there are no changes. And then by March 2022, almost all trusts, even where there aren't any tax implications, will need to register online with HM Revenue and Customs. So this has become I suppose, an additional part of our work annually, where we're acting for trusts. And finally, final section, we've got sort of 10-15 minutes. We try and run through some examples. I'll start with a couple as to kind of where we might use trusts. And firstly, I've looked at where we might use trusts in wills. So one example would be in connection with how we use life interest trusts in wills. And the example I'm giving here is John and Mary are married and own a home together. They both have children from previous marriages, and Patrick alluded to this being a common use of interest in possession trusts. John and Mary both write their wills to include an interest in possession trust and to sever the tenancy of their property so that it is owned as tenants in common rather than joint tenants. So they each own their separate 50% share of the whole. If, for example, John dies first, Mary will be entitled to live in John's share of the family home. However, his share will not pass to her directly. On Mary's death, her share of the property will pass according to her will, which would presumably be to her children. As the interest in possession has ended due to Mary's death, John's share will now pass to his capital beneficiaries, which would presumably be his children. This just ensures that that assets pass in accordance with each individual's wishes. So the benefits: protecting assets from bankruptcy, remarriage, long-term care costs. It obviously ensures assets go to the correct beneficiaries, as I've explained. Who would this benefit? Anyone who has children from previous relationships, anyone who has a big age gap in their relationship and remarriage is a concern, so they're concerned about where their assets might eventually end up if there's a remarriage. Anyone worried about hostile creditors, so having assets held on trust rather than by someone absolutely would be a benefit in that situation. Anyone wanting to ensure that their assets pass to the correct beneficiaries, as I've said in the section above. My second example of where we might use trusts in wills would be where we might use a discretionary trust. And this is a discretionary trust for business assets. So the scenario is as follows. John owns 100% of the share capital of XYZ Limited, which is a trading company qualifying for business property relief. In his will, he leaves the shares in XYZ Limited to his wife, Mary. It's likely, however, that the shares will be sold after John's death. If John predeceases Mary, the shares will pass to Mary with the benefit of the spouse exemption from IHT, but the sale proceeds will then arise in Mary's estate and would potentially be subject to inheritance tax at 40% on Mary's death. Now, in that situation, we might recommend that John, rather than leaves the shares directly to Mary in his will, instead leaves the shares onto a discretionary trust for the benefit of Mary and his family. The shares would pass on to the trust with the benefit of business property relief, and then when the shares are sold, the sale proceeds would arise outside of Mary's estate. So we then remove the risk of the kind of cliff edge 40% liability on Mary's death in exchange for the sale proceeds being within the relevant property inheritance tax regime that I explained earlier. It's also possible in this situation, if the shares weren't to be sold, it's also possible to claim business property relief twice. If, for example, the shares pass on to discretionary trust on John's death, and then Mary, with her chargeable assets, perhaps cash or other chargeable investments, she could swap those investments, or rather investments of equal value, for shares held by the discretionary trust. And once 2 years has passed, she can then claim business property relief again in her estate on her death. And on that note, I will hand over to Patrick for the last couple of examples.
Thanks, James. Well, firstly, I just wanted to touch on school fees trusts, as we call them. Now, these have been mentioned in previous webinars, but perhaps a little bit on these would be helpful. So imagine a situation where a gentleman, and I picked the name Fred, it's easy, has 3 children at private school, each costing £15,000 a year in fees. Now, Fred, as is likely to be the case for someone with 3 kids at private school, earns an awful lot of money, and he's an additional rate taxpayer. So that means that in order for him to find the £45,000 he needs each year to pay those school fees, he will need to earn £85,000 because there'll be tax and national insurance on that of around about 40. So that's an awful lot of tax. If he's in the fortunate position where his parents, so the grandparents of the children, have significant assets of their own, they might choose to settle assets into a trust for the benefit of their 3 grandchildren. Now, this could be a discretionary or an interest in possession trust, but it probably makes life easier if it's interest in possession because of the way the tax rules work, as James explained a little while ago. But let's say we manage to set up a trust and the trust receives income each year of around about £45,000 per annum. That money would then be paid, be due to the children if they have an interest in possession. It wouldn't be paid to them directly, it would be paid straight to the school to meet their school fees. So the trustees would pay that straight to the school fees met, and the income, because it's an interest in possession trust, or even if it's a discretionary trust for that matter, is taxed as if it's the child's income. Based on this being an interest in possession, each child would receive £15,000 per annum of income. That would be assessed on them, as I've said. They each have a personal allowance of £12,500. So the amount that would be taxable on them would be £2,500. and the tax on that at 20% would be £500. Now, if it was dividend income, that tax might be lower, but let's just keep things simple. So 3 children, £500 each, that's total tax per year, £1,500, compared with £40,000 if Fred had paid the school fees directly himself out of his own taxable income. So you can see there is a real potential tax advantage here by doing this. Now, obviously, you need to think about what happens to the assets in this trust after the kids have finished their school and so on, but that's detail we don't need to go into today. The point is, you can potentially save an awful lot of income tax by doing it this way. One other example I've put in here, again, one I might have mentioned in previous webinars. You have a situation where this time Fred is someone, he may be in his 60s, he certainly won't be particularly old, 60s, maybe early 70s. He's got around about £1 million, which he doesn't think he'll need to keep his lifestyle as where it currently is, but he's not quite ready to give it away. He might need some part of it. He wants to be cautious. So what we could do with him is, again, he sets up a trust for his children, and instead of giving the trustees money, he lends the £1 million to the trustees. The trustees then invest that £1 million, and they would expect, with reasonable advice on a cautious approach, to make somewhere between 5 and 7% per annum in growth on that. So the reason this is potentially advantageous is because, as I said, Fred's in his 60s, early 70s. Life expectancy tables would suggest he would probably live for another 20, maybe 30 years. And all the growth on that £1 million that he's lent to the trust will be outside of his estate, i.e. not chargeable to inheritance tax when he dies. So if we look at the next slide, we can see what that means in numbers, just very roughly. So for instance, £1 million growing at 5% per annum for 20 years would, after that 20 years, be worth £2.6 million. Now, that is a growth of £1.6 million that's not in his estate, not chargeable to inheritance tax. If we manage to wait another 10 years, so Fred clings on into his 90s or late 80s, and then after 30 years, that same £1 million will have grown all the way up to £4.3 million. Again, assuming a 5% growth rate. So 3.3 million outside of the estate. So you can see how this is a very simple way of having quite a significant effect on your estate for inheritance tax purposes in the future, using the passage of time and compound interest effectively to get a benefit outside of your estate while retaining the flexibility, if you wish it, to still access the original capital should you want it. And obviously, if you find you don't need that £1 million, it may be that in the course of that 20 or 30 years, Fred decides to give it away under the usual potentially exempt transfer rules. So a little simple example that we like to use in this sort of situation. As you can imagine, there's loads more that we could go into, but we've run out of time for that now. We do have a few minutes for questions, so I don't know, Kat or Steve, if we do have any questions that you might like to fire at us.
Yep, so questions just come in regarding your example of the school fee trusts, where you've got the 1,500 versus 40,000 of income tax difference. They were asking about what about the other tax charges on settling the trust for the children?
Well, yes. I mean, inevitably, there's more detail in this than I've covered in a quick example. But often, the way we do this would be money going in. The assets going in might be shares in a family company. The reason I say that is that if you have shares in a family company, they will probably qualify for business property relief, so you can get them into the trust without there being a tax charge because of business property relief. And you can dictate to a certain degree what dividends are paid on the shares in the company that end up in the hands of the children. So it allows you to be fairly flexible on how much income goes to them and so on. If you haven't got that situation and you're placing normal assets in, then you do have to be aware of the rules concerning transfer of assets to relevant property trusts, as James mentioned. So if you're transferring in more than £325,000 per set law, then on the face of it, the excess above that will be charged with inheritance tax at lifetime rates of 20%. So that would have to be factored into the calculations.
Yeah, it's most normally family companies, isn't it, Patrick? I mean,
that's what we tend to see, yeah. And We then mess around with the types of share class so we can pay dividends on them at the rate we want to meet the fees we need and so on.
Another question's coming about the trust registration deadline for non-taxable trust, asking if it's been extended by HMRC. I know that HMRC have pushed back when the system is going to be available to do that, but I wasn't sure that the deadline for doing it had been extended. I'm not sure if either James or Patrick, you've heard anything on that?
I haven't, no, I haven't. My understanding is as yours is, Kat. So there may be something I don't know, but not as far as I'm aware.
Any more questions?
Yeah, so there was one with regards to the beneficiaries being able to close and alter or vary the trust. If you have a trust with two adult daughters and they agree they want to change the trust, but there are other possible beneficiaries, so it's for children and remoter issues, can they still use that rule where the beneficiaries are able to alter the trust?
I think the answer is that it gets a bit more complicated. I don't know the certain position off the top of my head with regard to that, but I think where all the beneficiaries are known and agree, then certainly that rule in Storms and Vautier applies. Where you have an as yet open class of potential beneficiaries, I think an awful lot more caution is needed, and then we get into areas of arcane trust law, unless you know more than I do on that one, James. But I think that's a far less certain position. So because you can't get the agreement of all the beneficiaries.
I don't. I think I'd be contacting our lawyer friends at that if that question arose.
Certainly, I think things become tricky. You can have situations where you think a class of beneficiaries is closed, but it hasn't, because a male settlor is still alive, and the male settlor is deemed to be able to have children until they are dead. It doesn't matter how old and incapable they may be. The law says they can still have children, so that can keep classes of beneficiaries open for a very long time. And while it is open, you often can't quite bring things to a close.
A few have come my way, James, if I may. They largely revolve, if I can paraphrase, around transfers to trusts on the capital gains inheritance tax, stamp duty, land tax, stamp duty position. And a number of people have asked about would such taxes arise if you make a sale or a gift? That's actually probably quite a bad paraphrase of the questions, but I think that's the substance of it.
So we're talking about stamp charges.
Yes, SDLT and stamp duty.
I mean, the basic rule for SDLT, and I believe stamp duty that apply on shares typically, is that the tax is only chargeable to the extent there is consideration provided. So normally when a settlor is transferring assets onto a settlement, consideration isn't provided, and therefore stamp duty, land tax and stamp duty isn't payable. That would be the norm. If, on the other hand, we have a situation where a settlor is selling assets onto a trust, in other words, so a trust is acquiring assets from someone, then they would pay stamp duty, land tax or stamp duty in the normal manner. Another relatively rare situation might be where a settlor is transferring property onto a trust subject to a mortgage. So the trustees are assuming the value of any outstanding debt. In that situation, the value of the debt assumed would be regarded as consideration, and stamp duty, land tax would be chargeable on that amount. Hopefully that answers the question. Steve, is there questions on other taxes?
Yes, well, I think that probably one or two people required a bit more clarity on capital gains tax and inheritance tax on settlement as well. But clearly that's a topic about, people write books about that sort of thing. So maybe not that one, but there is another one which has recurred, which is people have been told that the shares in a family company should be in trust. And the question is it a good idea? Which is probably another rather wide topic as well, but a flavour would be nice.
Blimey. All sorts of reasons why some some shares should be held on a settlement, usually depending upon the circumstances of the business owner. And I'm thinking here of, an owner-managed business, perhaps husband and wife or something. So if, for example, and I'll just use a couple of examples. First example being, let's say business owner wanted to provide in the way that Patrick explained for grandchildren, then we might say, okay, transfer a small shareholding, perhaps of a different class of shares, onto a family trust for the benefit of, primarily the grandchildren, and pay dividends through that trust in the way that Patrick explained to grandchildren, typically for school fees and things, but it doesn't have to be for school fees. And you get all the income tax benefits that Patrick explained. So that might be a reason why we would recommend, or a scenario where we would recommend, that a small shareholding is held on trust, and that would be primarily for income tax purposes. There might be other situations for business owners where we might foresee that qualification to things such as business property relief might become more difficult. Let's say the business is changing its nature from trade to investment or something like that, and we're thinking about inheritance tax planning for the business owner. In that situation, we might encourage them to divest themselves of a greater portion of the company onto a trust for the family, or the rest of the family, whilst it qualifies for business property relief. So there's a couple of examples, but it's very, 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 circumstance driven, I think.
Yes, it's a wide topic and depends on the facts, as is always the case. I'm conscious we've gone about 5 minutes over our allotted time. Perhaps we can do one more question if there is one, and then we better call it a day for those that do want to hang on for one more.
Can I just quickly say about the trust registration question? I have just been looking that up, and HMRC are intending to defer it to 12 months after the system becomes available because of their delay in getting this software available. So there is a potential delay to the March 2022 deadline that we said in the slides. Another question that has come in was to do with if there are any completely tax-free trusts.
I think the probable answer to that is no. The excluded property trust that James mentioned is probably the closest, in that it potentially gets you out of a lot of inheritance tax. But if you've got income coming out of a trust to UK beneficiaries or capital gains, then generally speaking, there will be some tax charge. I think I'm right in saying that, James, aren't I? Yeah, tax-free trust. If there was, we'd be using them all the time.
Yeah, it's difficult. It's a difficult question to answer. I suppose strictly, the only tax-free trusts, or potentially tax-free trusts, bare trust, because it's just nominee arrangement. It's an ownership point rather than being relevant for tax purposes. So bare trustees shouldn't pay any tax.
That's true, but of course the assets and the income is taxed. It's just taxed.
Oh, absolutely, yeah. It doesn't prevent the assets or income from being taxable. And I suppose strictly, charitable trusts will very, very rarely pay tax. But it's not, there are occasions when they do. Sorry, I don't think there probably are.
No, I think for the purposes of what I suspect is the reason behind the question, there isn't. I'm assuming we're not talking about charities in that question, but so I think probably assume no, there isn't a tax-free trust, but there are certainly trusts can be very advantageous for tax, but you don't avoid it entirely. You may be able to delay it, you may be able to reduce it, but you're probably not going to get out of it, is a general position to take. I think we probably ought to bring it to an end now. I'm conscious people have gone for an extra 7 or 8 minutes after the time, so thank you for that. I hope you found that interesting. We do have at least a couple more webinars lined up, isn't it? Family investment companies next, and then we're doing investigations and what the revenue might do to you if they think something's wrong with your affairs and how it might better help. So I hope to see or hear some of you on those in the future. Otherwise, thank you very much, and we'll see you again in a month's time.